Hi, my name is Paul Sundin and I'm with Empyrean. Today we're going to talk a little bit about a topic that comes up often after the fact. You've set up a plan and you want to know, how do you actually include this, or where does the actual cash balance plan contribution go on the tax return? We're going to talk a little bit about that today. I talk to CPAs a lot that aren't as familiar with these plans, that I kind of give them some assistance into, how to set these things up and or how to record them on their tax returns. So we're going to cover multiple different entities in this video. We're going to do it somewhat at a high level. If you've got any questions, you may already know this. I am a CPA by trade. I've done thousands upon thousands of tax returns, but the forms and schedules change all the time and the lines on the forms do. So I may not be up to speed on the exact location, but the substance will still be the same. If you have any questions, or you're a CPA and you want to understand a little bit more, feel free to reach out to me. I'd be glad to help you out. Before we dive in though, make sure you like the video, subscribe to the channel, leave a comment below if you've got any questions. We do review those and answer those from time to time. Okay? So we're going to start off by talking a little bit about sole proprietors. One of the issues I often see, and this is from CPAs and people doing their own tax returns, is they take the contribution to the cash balance plan and they put it all on their Schedule C. Okay? Schedule C is where you record the sole proprietor income. That is correct if you've got employees that you're contributing to. But if it's a solo plan and there's no employees, you wouldn't contribute it there. You'd actually put it as an adjustment to income. It would go on the Schedule 1 to the actual 1040 return itself. Okay? So not on the Schedule C, on the other schedule as an adjustment to income. Unfortunately, these plans do help you avoid Social Security and Medicare tax, but they're not going to avoid any sort of employment taxes. So that's kind of step one. Make sure you get that in the right location. Can be a little bit more challenging again for sole proprietors. Most of the software out there, even if you're using TurboTax or whatnot, there should be a line for defined benefit plan. Not something that the software is going to calculate. You'll have to put it in and or overwrite it. A lot of the tax software, the more sophisticated software, will give you a good location to put it in, but not so sure on the TurboTax side. But anyways, make sure it's not on your Schedule C. Make sure it's an adjustment to income. Next entity would be an S-Corp. Now, most of our clients have S-Corps. It's probably the best and most used entity structure for successful small businesses, family-owned businesses per se. S-Corps, it becomes rather simple. You just put it on the actual corporate return itself. I know they change the lines every year. It's line, I think it's 21 or 22. There's a line that says something to the effect of SEPs, SEPs, pensions, and other qualified plans. Cash balance plans and defined benefit plans are qualified plans, so you'd put the number there. You would also, on that line, put the number for any sort of profit sharing. If you had a 401k plan, just the profit sharing contribution will go on that line. If you've got a deferral for a 401k, because you're combining these plans, the 401k deferral does not go on that line. That is actually on your W-2. So it's a reduction on your W-2, shows up in box 12 as 12A on code D for the deferral. So that's going to go there. You're going to record your compensation at gross. You're going to take the net amount reduced by your deferred 401k is going to come off on your W-2. You're going to put the net amount on your 1040, and then your cash balance plan and any profit sharing is going to go again lumped in with that defined benefit plan contribution. Okay? Obviously the difference is going to be on a K1, and that's going to flow through to you. For C-Corp, don't see as many C-Corps, but we still do see them. C-Corps obviously are self-contained entities, so they're going to pay their own tax. C-Corps are going to be just like an S-Corp from the standpoint of where you put it. It's going to be on that same line, SEPs, qualified plans, and other pensions. You're going to put it there. It's going to be a reduction. It's going to reduce your net income. There's no K1 at that point, so you don't need to worry about flow through income. The one issue obviously people have C-Corps have to address is often people with C-Corps are trying to schedule it so they can get to a break even. You typically don't want a net operating, typically don't want a loss. If you have a loss, not a big one. So, that's one of the things they can consider on those funding levels. But anyways, still rather simple. Again, a few more headaches because it's a self-contained entity, but from a tax standpoint, a little bit more straightforward. Now, the most complex place or return to record it would be on a partnership return on Form 1065. we don't have as many of these, but still you'll see them for, maybe law firms or other types of medical practices or whatnot. If you have a contribution for employees, again, that's going to go on that same line, that kind of SEPs qualified plan lines on the face of the 1040. But for the actual individual owners, you're going to put that as a schedule specifically on the actual K1. So you're going to put the amount allocated to each of the different partners specifically on the K1. That way, when the accountant does the return, does the personal return, they're going to pick up the gross income allocated to that partner. They're going to offset it. Again, that's going to be all subject to Social Security and Medicare, and that'll show up in the self-employment income line. And then they're also going to have to deduct the contribution for the defined benefit plans. So the accountant's got to take those numbers off those separate K1s, put them on the 1040s. They got to do that for each of the specific partners. Makes the process a little bit more complex, but again, you don't put it on the face of the 1065. It's going to show up on the K1. That way it'll flow through to the partner's individual tax returns, and you will be paying employment tax on that, as long as you make sure that you've got that net income box is showing up as self-employment income, as long as you're not a passive partner or whatnot. So hopefully this was a nice overview for you. I hope you learned something from this. We do have an article that addresses this topic as well that's pretty detailed. We're going to put a link to it down below. If your accountant has any questions or concerns, make sure you share this video with them. And if you've got any other questions or whatnot, or want to ask us about the tax ramifications or consequences of these plans, make sure you reach out to us, and we'll be glad to help you out.